Hello and welcome to this AIRMIC Fest workshop, all about the concept of virtual captives and why they may be increasingly relevant for corporates in today's market. My name is Richard Kutcher and I am AIRMIC's Captive Ambassador. Joining me are two leading names from Swiss Re. We have Nigel Bamber, Head of Customer UK at Swiss Re Corporate Solutions, and Thomas Keist, Global Captive Solutions Leader at Swiss Re Corporate Solutions as well. We have a short presentation of 20 to 30 minutes prepared for you now, and then we are going to move over to an extended live Q&A on Microsoft Teams once we have finished. So please do consider and save any questions you may have for Thomas and Nigel until we launch into that live Q&A, and hopefully we can have a really good discussion with our delegates in that. We will give you instructions of how to do that and join the live Q&A at the end of our presentation, so please bear with us for those. We do have some key learning objectives today, which should give you an idea of the types of topics we'll be covering, and hopefully you can take away from this discussion. So hopefully by the end, you'll be able to identify how to achieve many of the risk financing advantages of having a captive without actually having one, explain how an insurer can handle the administration of the supporting balance sheet, taking it off the corporate's balance sheet, and lastly, cite how the virtual captive agreement emulates the financial mechanics of a traditional captive. But before we get into the nitty-gritty of virtual captives, Nigel, I thought I'd bring you in first, really, to give us perhaps some context from you on in regards to how the virtual captive fits into some of the wider alternative risk financing options that you work with insurance buyers on.
Yeah, thanks, Richard. And I think probably good morning all, and nice to see you. Yeah, indeed. This virtual captive proposition forms part of our risk financing solutions suite that we use to help clients structure their insurance solutions in a cost-effective way. So, for example, we offer cross-class protection across quite a few different product lines, which help captives reduce capital and or volatility. And this kind of solution is what we call a meat and drink solution for clients. And structured solutions probably forms about 50% of our book of business in this kind of innovation space. About 30% probably relate to parametrics. And on parametrics, we certainly see a huge increase in terms of interest in the last 2 or 3 years. And then fronted solutions probably form about 15%. I'll just make a couple of points, Richard, just a couple of final points, really. I think these structured solutions, and the one that Tom's going to speak about, are of real increasing importance in the hard market. And secondly, I know we're talking about this, but actually as a company, we walk the talk. So in 2019, in the kind of innovation space, we closed nearly 200 deals and a premium volume of about 350 million. So we hopefully know what we're about. We're a thought leader in this space. And we really enjoy engagement with the clients and brokers in this discussion. There's not just an easy answer. This is a discussion. It's working together. And to be honest, it's fun as well. Back to you and back to the focus of the meeting.
Thank you, Nigel. No, I'm really looking forward to hearing a little bit more from Thomas now on virtual captives, because I've talked about captives for 7 or 8 years now in my role as a journalist previously, and virtual captives has always been one of those things which has just kind of been mentioned in passing. I've never really dug that deep into it myself. So, Thomas, perhaps to get us started, could you outline for us what a virtual captive is and how it differs from what we might know as a traditional pure captive?
Well, thanks, Richard, for the question. And I think it's fair to say, I mean, the situation today is a completely different one from, probably the years before, let's say 2019. So we have a completely different situation now, and that's why these kind of structured solutions are now all of a sudden on the plate again. And at the moment, we see really a huge surge in demand for such solutions, which is understandable. And we're actually very happy that as VC Corporate Solutions, we are actually able to provide a solution which is hopefully innovative and hopefully something that's really of use within the current market environment. So clearly, a virtual captive is for those corporates who have already made certain decisions. And one of the key decisions is that having a captive, in theory, having a captive would be the right answer to their insurance needs. So as opposed to, for example, just increasing deductibles and carry the risk on their own balance sheet and pay as you go, the losses that are in this respect, you as a client, you have decided a captive would actually be the right answer, the captive with all its benefits. But they are evaluating alternative to setting up a captive because you are, for example, seeking to avoid the time needed, the cost and complexities of setting up a real captive. And you are also considering later exit options as well, and or you might want to bridge time until the real captive is established. It is for exactly those clients who a virtual captive is for. Now, what is it? A virtual captive is basically a multi-year insurance agreement that emulates the mechanics of a traditional captive on an insurer's balance sheet. And when I speak about mechanics, I mean the financial mechanics. The financial mechanics, in essence, a captive and the virtual captive, they are both a vehicle of self-financing risk over time. And that's what a real captive does, and that's also what a virtual captive does. So again, the virtual captive emulates the mechanics, the financial mechanics of a traditional captive, but on our balance sheet. So basically, we use the infrastructure that's already here to offer this infrastructure to our clients to emulate the mechanics of a captive. There are certainly some contractual elements within that multi-year insurance agreement which are a bit different to a traditional insurance agreement. They are needed to achieve the effect we want to have. And those are the following. First of all, it's multi-year. So the risk financing happens over time as with a real captive. Premium. The premium contribution to the virtual captive program implicitly finances a larger part of the risk over time. If you think about it, in a real captive, of course, the sum of the premium contributions to the captive should be enough to finance the expected losses that the captive covers. And the same is the case for a virtual captive. And therefore, the premium contribution is calculated such that it achieves exactly that. So that's the structural element number 2. Structural element number 3 is because of structural element number 2, there is also a low claims bonus, right? So if the loss experience of the virtual captive is good, there is a low claims bonus due at the end of the period, much like a captive would pay a dividend due to an underwriting profit within its balance sheet. Last but not least, there is a possibility for an additional premium feature. So if losses exceed certain thresholds, they go much worse than expected, an additional premium can become due. This is an optional feature. Sometimes it's not needed. But in essence, if you think about it, an additional premium is nothing else than an additional call for capital of a real captive. So if a real captive, if the capitalization gets thin, then of course there's a call for additional capital injection. So in a virtual captive case, it's basically the additional premium.
So So Thomas, in with traditional captives, particularly in the European market, it tends to be the larger accounts that qualify or are suitable for a captive structure. What type of insurance buyers should the virtual captive approach be suitable for? Is it the similar type of profile, or does it also go to maybe the mid-market as well? And where are you seeing interest already being expressed into virtual captives?
So, uh, let's first look at the advantages of a virtual captive, and I think that will lead a lot towards who is suitable for looking at such a solution. So basically, whilst the traditional captive is set up as a reinsurance company or an insurance company within a corporation as a legal entity, a virtual captive is a multi-year agreement with an existing licensed insurance company like Swiss Re Corporate Solutions. So what are the advantages? The client has the same self-insurance functionality as a real captive or a PCC, but there are no setup costs and complexities. No capital injection is needed, and there's typically no collateralization needed. There's no regulatory approvals or reportings, no expenses for captive management. It's relatively speedy implemented. It has Swiss Re Group's financial strength behind it, which is sometimes quite an important piece. And there is also a relatively a simple way to exit again. Because if you have a real captive, basically it is a lengthy process to basically close it down again. So you cannot just walk away and close the door and that's it, right? Whereas if you have a multi-year insurance agreement, you just don't renew it. Of course, there is a discovery period, commutation, and so forth, but still, it's a much simpler process. So, on your question, Richard, the solution suits those who maybe just don't have the critical mass yet to form a real captive, or maybe they have not the time to do so, or maybe they are not really sure whether this concept of a captive, right, the captive approach for the insurance program is really theirs. So for all these, and these are typically also the client segments that come to us. So it's not the very small one, the very small clients, it's sort of the upper middle market, who are typically thinking about such concepts, and they come to us, and they really like exactly these three pieces that I just mentioned.
So Thomas, you mentioned there on this slide actually that it has the virtual captive has much the same self-insurance functionality as a real captive or a PCC, and it sounds to me that some of the advantages that you're talking about regarding the virtual captive are quite similar to what advisors often argue when they put forward a sell in a rent-a-captive program as a kind of easy, quick-to-market way to have a captive style vehicle. Is the virtual captive very, very similar to a kind of a rent-a-sell arrangement?
It is definitely an alternative. It is not comparable because different to a protected cell company where you gain ownership of a part of another company, right? You own this cell. In a virtual captive situation, you do not have ownership of any sort in Swiss Re Corporate Solutions balance sheet. So it's the number one difference is the ownership difference, which ownership has sometimes advantages, but it also has the disadvantage of responsibility for then making sure all the regulatory, financial, and so forth obligations are met. So this is one difference. The other difference is, of course, coming with that, because there is no ownership, you do not need to inject capital into this virtual captive. There is no capital injection, and also usually, by far the most cases, there is no need for any collateralization of any sorts. Whereas you still have that with, at least partially with a protected cell company. But from a mechanics point of view, absolutely, a protected cell company, like a real captive, is a comparable alternative to a virtual captive.
Fantastic. Then, well, just lastly, before we do jump into the live Q&A, so please do have your questions ready, delegates. In what circumstances might a virtual captive make sense, do you think?
So I think there's two steps clients need to make before starting to talk to us. And so the first step is really make sure you understand, or you have decided that a captive is actually the insurance vehicle that is of your choice and is the right instrument as a loss payment instrument for your risk self-insurance needs. And that's the first step. So make sure you have decided the captive approach would be the right approach. And then the second decision is you have decided that your expected loss is significantly lower than what the commercial insurers' premiums imply. Right? So this is, of course, a very crucial assumption you need to take. Else it always makes sense to just buy commercial traditional insurance. So that's the first piece. The second is faced with a situation where premiums are always increasing, capacity is becoming more limited, and is for those clients who basically then say, well, having a captive or a virtual captive would now be the right thing. And last but not least, it is for those who intend to access the wholesale reinsurance market in search for better terms and additional capacity, because you also do this with a captive. If you have a captive, you have access to the reinsurance market. With a virtual captive, we can set it up such that it also achieves exactly this benefit. So at the end of the day, a virtual captive is for those who have decided that a captive will be the right answer to their insurance need, but they shy away from setting up an insurance legal entity for that.
Fantastic, Thomas. Really, really good, nice, thorough, but brief introduction to what a virtual captive is. And I know that I've got lots more questions to ask, and I'm sure our delegates will do as well. So that wraps up this presentation portion of the workshop. As I mentioned at the top of the session, we are now going to move into the live Q&A. So please do have some questions ready to put to us, and we'll tell you how to do that once we're in there. And to join the live Q&A, please return to the AIRMIC Fest platform and click on the live Q&A Microsoft Teams link next to the title of this session. Do make sure you're clicking on the link next to our session, otherwise you'll be joining someone else's live Q&A and they won't know what you're talking about when you ask them about virtual captives. So hopefully we'll be waiting for you there. See you in a second.